let's start with Latentview Analytics, which reported its results over the weekend, and it's been a pretty decent quarter. Revenue up about 9%. PAT has actually gone down about 12.5%. But what were the factors that led to this kind of a result? For that, we are now joined by Rajan Venkatesan, the CFO at Latentview Analytics. Hi, Rajan. Very good morning. Thank you so much for joining us today. Let's first talk about your financials. Please take us through what drove your consistent 10-quarter growth that you have seen, and how do you plan to sustain it over the next few years?
Good morning, and thanks for having us on the show. We've, like I said, right? I mean, this is our 10th consecutive quarter where we've been able to deliver sequential quarter-on-quarter growth. Of course, if you see historically, a lot of our growth, as well as some of our top clients, are in the technology vertical, and a lot of our growth, even in as we were sort of getting matured as a company, was driven by the technology vertical. But especially over the last, I would say, 2 to 3 quarters, we've been seeing fairly strong momentum in the banking and the financial services practice, as well as the CPGR practice. And this is not by chance. This is very intentional. Even if you go back and read our prospectus, of course, we went public close to about 3.5 years back. But then at that point in time, we indicated that these were 2 verticals that we want to invest because from an overall market standpoint, these are verticals that spend a lot on analytics initiatives, and therefore there were a lot of investments that we had made to drive growth in these 2 verticals, and we are beginning to see results, right? So you will see that our CPGR practice as well as the financial services practice were the ones that drove most of the growth in this particular quarter. Financial services specifically grew by about 30% on a sequential basis, right? And on a full year basis, we expect the financial services practice to deliver a growth of anywhere between 70 to 80% on a YOY basis. So very strong momentum that we see in financial services practice. Of course, they're still on a low base relative to where the technology practice is. So that's what has driven growth for us, I would say, in the last 2 to 3 quarters. In terms of the profitability, you did speak about a drop in the PAT. The one thing that I do want to note is the last quarter, we had a benefit as a result of electing to go with the new tax regime for India, and therefore we had a one-time deferred tax income that we had recognized, and therefore our ETR for the last quarter was significantly lower. The ETR for this quarter, you will see that was close to about 25%, and this we believe will be the ETR going forward, right? So therefore, PAT will not have this sort of an up and down swing going forward. So you will see more steady state PAT percentages as we move along.
Rajan, we look forward to that. Hi, morning. This is Shrishti also joining in. So many factors that you just answered. But talk to us about the GenAI opportunities. What sort of a growth that you are targeting in this particular segment? And also give us a sense on the margins. How does the margins play compared to your core analytics?
Yeah. So I know it's a burning question that I think most of the technology companies are answering at this point in time. And we are no different, right? Of course, we are a business that is not new to using AI in delivering work. In fact, we've, of course, been using AI for a very long point of time. Of course, some of the recent advancements in technology have meant that consumers like you and I have access to technology like this. Having said that, we are seeing fairly strong momentum as far as the GenAI practice is concerned. For this year, we believe this should add anywhere between $8 to $10 million of revenue for us on a full year basis. But that's just the revenue that is on the back of what we are delivering as GenAI solutions, right? There are, of course, significant GenAI elements that we are embedding into a lot of the work that we are doing already, both from a delivery standpoint to drive efficiency, as well as embedding it as part of larger solutions that we are deploying for clients, right? Which we don't call as GenAI projects, but then we use a lot of GenAI based technologies to deliver that work. So I would say from a contribution standpoint, while absolute revenue attributable will be 8 to 10 million, but from an efficiency as well as the overall service offering, it will be a lot more higher. As far as margins are concerned, see, I don't think the margins are very different for us between the traditional book of work versus GenAI. Not very different, because again, this is a very evolving space at this point in time. But the margins vary based on the complexity of the problem that we are trying to solve, as well as the level of data readiness or the how solid the data foundations are, right? So a lot of the work that even goes into delivering GenAI work is around ensuring that the data foundations are set in place, because ultimately that's the only way you can avoid issues like hallucinations or inaccurate sort of decisions that can get triggered as a result of data foundations being poor. So a lot of work today on the GenAI side is again happening on that space. But margin for us right now is not very different from what we see for our other businesses.
Understood. So that's about the Gen AI space. But Rajan, just wanted to understand this margin that you're talking about. That was about the Gen AI space particularly, right? Because overall your margins have remained around that 21% level. So any pressures or headwinds that you're facing, and what's the projection? Are you profit? You said it's going to be steady over the next few quarters. What's the projection for margins? How are you going to expand?
So as far as margins are concerned, the one thing that we can guarantee is there is no pressure as a result of pricing. Okay. In fact, as a practice, we typically tend to operate at gross margins in excess of 50%, right? And that's something that we try to consistently sort of maintain, right? And even in historical periods, they used to hover around 55, 56%. Right now, they're probably at about 51 to 52%, primarily because I would say COVID ensured that a lot more work was getting delivered offshore, and typically offshore margins are tend to be higher. But then we've seen a little bit of a reversal of trend in the last, I would say, 2 to 3 years, where there is a little more work that we are delivering through, in our on-site locations. What we are also beginning to see is there is a significant uptick as far as the nearshoring opportunities are concerned. Also triggered by the fact that there are these new H1B rules. We believe this will be a significant boost for our nearshoring capabilities. So we are establishing delivery centers. One, we already have a center in Canada. We also have a presence now in Mexico as a result of the Decision Point acquisition that we've done, right? So both these nearshoring locations, we're seeing fairly strong traction within our existing client set. In a go forward basis, we will be, I think what the sort of typical deployment model would be 10% people based in on-site locations, maybe around 20% based in nearshoring locations. Sorry, 20% on-site, 10% nearshore, and then about 70% as far as offshore is concerned. So we will see a little bit of a shift in the way we deliver work. This should again augur well from an overall margin standpoint. The reason why our margins have been a little, I would say, muted over the last 2 to 3 quarters have been the investments that we are making on the capability building side, as far as our GenAI practice is concerned, as well as Databricks practice is concerned. So we are investing ahead of the curve. You will also see that in the sort of growth rates that we've clocked for this quarter. So we want to invest for growth. And we believe both these areas that I've outlined, right, which is the GenAI practice as well as Databricks, are very, very core and integral for delivering sustained high percentage growth, right? So we will continue to invest. So the lower margin or when I say the slightly more muted margin, is only on account of higher investments that we are making below the line, and not necessarily pricing or cost pressures.
Rajan, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us, and we'll definitely